It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me, yourpersonalbank.com. Some of the things I shared a couple of weeks ago regarding the precious metals markets, particularly gold and silver, have turned out to be quite prophetic. Recently, gold had a historical drop of 9% in one day, and silver dropped 26%, which was an all-time record. Now, the reasons behind this we're going to discuss and share. This is not surprising. Gold and then later silver were increasing at almost a parabolic rate, much like what we saw with GameStop a few years ago. And whenever you see any asset going up at an unsustainable rate, dramatic like that, it's going to correct. It's just a matter of time. And anyone who's involved with that, the professionals, when they see a strong increase in a short period of time, the wise thing to do is start to scale out, lock in some of your gains. And that was the advice I gave a couple of weeks ago. So anyone that had been in the precious metals markets, particularly gold and silver, and you've been involved for the past, say, 6 months, a year or more even, locking in some of those gains is just wise. If you lock in a third or half or so, for example, let the rest ride, at least you locked in and didn't lose when the correction and then the inevitable correction occurs. But what was the trigger? There's always a trigger. No one really knows what that's going to be on any correction until after the fact. Well, this time, the trigger turned out to be Trump announcing the next Federal Reserve chair, Kevin Warsh. Now, why is this so significant? A large part of the reason, as I shared a couple of weeks ago, for the significant increase in gold and silver prices was the concern about inflation, the federal debt, financial institutions really losing control of that going forward. And those are valid concerns, frankly, if you see how the Federal Reserve has handled this asset bubble. Much of the stock increase, the real estate increase in values, and more recently, gold and silver, has largely been caused by the Federal Reserve just printing way too much money. In fact, starting in December of 2025, the Federal Reserve is now printing $40 million a month in what they call liquidity or QE, quantitative easing. They print money out of thin air. They buy stocks, mortgage-backed securities, things like that, to create liquidity into the markets. They've been doing this consistently now, for the most part, for the last decade plus. And when you have a Federal Reserve that's dovish, as the term is often used, where they keep printing the money, that's going to inevitably cause asset prices to continue to rise. It's basic, simple supply and demand, folks. You got more dollars in the system chasing assets. So assets are naturally going to rise. And this is the biggest reason why we've seen such a significant rise in asset prices. And unfortunately, it's caused a dichotomy in our society because about 30% of Americans own stock and about 70% do not own significant amounts of stock. So those that did not own stocks over the past decade have been left behind. Also, those that did not own real estate also got left behind because wages have not increased anywhere near as much as asset prices. The Federal Reserve has, in essence, created winners and losers. Now, Kevin Warsh was a Federal Reserve governor back in the Great Recession days. I believe his term was around 2006 to about 2011 or 12. So he's well-known, well-respected. Here's why we've seen such a dramatic response, particularly with the gold and silver markets. If Kevin Warsh is confirmed as Federal Reserve Chair, and all indications are that he will be, again, he's well-known, well-respected, this will be a sea change in monetary policy from the Federal Reserve. And don't forget, the Federal Reserve is the 800-pound gorilla, folks. Two of the biggest things that the Federal Reserve does is determine interest rates and then what's called the Fed balance sheet. I'm going to discuss both of these and how these affect interest rates and how these affect the economy and also what is likely to be expected for asset values going forward. What we have seen for the past decade plus, like I said, is what's called easy monetary policy. Overall low interest rate environment and lots of money printing. So the overall money supply keeps increasing because the Fed keeps printing more and more money. That pushes asset values up, particularly, again, stock, real estate, precious metals, cryptocurrencies, those types of things. Kevin Marsh was a shock to the system because the markets were expecting in essence, more of the same. There were three candidates Trump was looking at, and it was thought that one or the other candidates who would have been much more like the current, like Jerome Powell approach of continuing that easy monetary policy, continuing printing of money, would be the status quo. In other words, would continue forward. Well, Kevin Marsh is a whole different animal. In fact, he was very, very critical about quantitative easing. In other words, the Federal Reserve printing more money. He did vote in favor of the first QE, which was known as the TARP program. Those of you that remember, around the 2008 financial crisis, he did vote in favor of the Federal Reserve printing a bunch of money, getting the financial markets going again, because, as he stated, we were in a crisis mode at that time, at that point in time. And in that, he's correct. But he was very critical about QE 2 and 3 and 4 and beyond. As he pointed out, the additional printing of money was going to be inflationary and was going to create an asset bubble. And he was right. He was so critical, in fact, that he resigned his Fed governor seat in protest. That gives you an idea of how adamant he is about maintaining a smaller balance sheet. In other words, not printing so much money, not for the Fed not to buy so many assets, and also for the Fed not to be lowering interest rates at super low rates indefinitely. As he put it, he believes the Fed's position, this is from recent interviews, in fact, he still believes this, that the Federal Reserve's role is to be there in an emergency, let the markets kind of play themselves out more or less until there is an actual crisis. Now, this is going to cause some significant changes in the economy, in investing, in interest rates. In other words, the status quo is not going to continue, most likely, if Kevin Marsh gets his way as Federal Reserve Chair. You're likely going to see the Federal Reserve stop printing additional monies, and not only that, start selling some of the assets they have on their balance sheet. So it's called quantitative tightening. Those are things that those are deflationary and tend to cause asset prices to go down. Now, he is in favor, he said, of bringing the interest rates down a little bit from where they are now. He believes they're slightly on the high side. And statistically speaking, over the long-term averages, he's correct. They're about 1% maybe higher than normal on average. What's highly unlikely is we're going to see super low interest rates. The reality is, I don't think a lot of people really understand how significant of a change this is going to be. The markets reacted initially dramatically with the gold and silver in particular, also with the stocks, the NASDAQ, the S&P, etc., because one of the primary causes of pushing prices up continually is probably going to stop in the next few months. The likelihood of gold and silver, for example, continuing their rise, lower inflation is bad for gold and silver prices, for example. J.P. Morgan recently even stated that they do not believe that silver will likely reclaim its 120 peak price it was at just very recently. It's also stated in terms of gold that they believe it's going to be very volatile for a while, in particular with the change in the economic situation with the Federal Reserve. I think we're going to see the same thing with markets, the stock market in general, because there's going to be an adjustment period. That's the bottom line. So again, a lot of volatility is what's predicted and expected. Another aspect of this is if the Federal Reserve is going to be more on the sidelines, you're going to see more ups and downs, more volatility in the market. You're going to let the markets kind of do their thing instead of just kind of marching up all the time with occasional blips, which is what we've seen, frankly, for the most part, since 2008. A lot of people, I believe, are going to be in for a rude awakening, is my point. Now, whenever there's volatility, uncertainty, That causes opportunities at the same time. Now, what can a person do? Well, if you're reluctant to stomach the ups and downs of a volatile market, while we see this changeover occur over this next year, particularly for the rest of 2026, let's say, an index product might be your best candidate. And why I say that is, again, we have unlimited upside products with no downside market risk. We have options that have no fees, no cap. So again, unlimited upside. And I've got several different indexes that have averaged over 10%, actually closer to 11% over the past decade. Some of them have given us actual returns approaching up to 27% in just 1 year. Now, if the markets are going to go into a correction or a volatile stage, I think that's really what we're looking at. The NASDAQ, the S&P, gold and silver, if you look at all those charts, there's no question they're been on the downside recently. Some of them are getting, like the NASDAQ and S&P, are getting to what I would consider kind of critical levels in terms of, are they going to continue on the downward side, or are we going to see a recovery from here? It's hard to say. But one of the advantages of an index product is with that downside guarantee. Let's say you get involved in that, you invest in it, and the markets do go down and they correct. For one, you won't lose whatever you put in. The principal's guaranteed. But if the index, say the S&P or the NASDAQ index, for example, declines, and then the next year you didn't make any money, but you didn't lose, but you also get to reset at the lower index number, which means when it does recover, you get to grab the upside. Instead of being involved, writing it down, taking the loss, and then having to recover from that loss. Look, if the index goes down 20% in a year, for example, not only do you lose 20% in value, but how long does it take to recover from that? If it takes more than a 20% return, by the way, to make up the loss. And how long does that recovery take? A year, 2, 3? I don't know. So the reality is that not only in the loss year you lost that money, but then in the recovery you didn't really make any money. You just got back to even, if you understand what I'm saying. So all that is lost time. That could be a couple, 3, 4 years even of lost time. Where if you were in an index product, you didn't lose the principal in the bad year or 2, whatever that may be. But then when it does recover, you recover from the lower number. So again, that's why I believe index products really, really shine in volatile times. If you want more information, contact me at yourpersonalbank.com for more info. I'm going to share more about this and some specific examples with some clients I shared this week. But I also want to still continue to share some more bigger picture issues about the economy and interest rates, particularly short and long-term interest rates that I think you're not going to want to miss. I'm Ference Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com. Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. Trump announcing the new Federal Reserve chair. It's most likely going to be Kevin Warsh. We're looking at probably a more hawkish Federal Reserve going forward. They're probably going to reduce the balance sheet, which means they're going to sell assets, not keep buying them, keep printing money. Most likely see less of that. That'll be less inflationary. They have agreed they want to reduce interest rates a little bit, but not. I don't think we're going to see dramatic reductions in interest rates on the shorter term rates. Maybe a point. That'll be good for shorter term borrowing, things like lines of credit, home equity lines of credit, commercial lending. Most commercial loans are 3-year adjustables. So the Federal Reserve has a lot of impact on shorter term interest rates, think 3 years or less. But the Federal Reserve has a lot less control over longer term interest rates. Stuff between, say, 3 and 10 is kind of mixed. Obviously, if the Federal Reserve reduces interest rates, it will have some impact on a typical auto loan, a 4 or 5 year loan. but not as much as, say, the shorter term stuff like lines of credit, commercial mortgages, things like that. Before I get to the long-term stuff, which has to do with the bond market, I just want a little aside. I taught a college-certified financial literacy course for a couple of years, and this is a question I get quite often, auto loans, things like that. For one, if you cannot pay cash and you have to finance, one, I'm going to say you never want to have a loan on a vehicle more than 4 or 5 years max. If you're going longer than that, frankly, you need to downsize. If you have to stretch the term longer because you can't afford the payment, honestly, you got to downsize the quality of the car or the vehicle. Secondly, with rare exceptions, don't recommend buying a brand new car. That's because if you purchase a new vehicle, you're going to lose probably 20% or so of appreciation just driving it off the lot. You're much better off, say, buying a 1 or 2 year old lease return with low mileage. The exception to the rule is when you get into work vehicles. Those tend to hold their value more. You get into, 1-ton dualies and larger. Sometimes buying new makes sense at that point because, well, they just don't depreciate that much. And often it's hard to find a used truck because people tend to keep those. They're work vehicles. Another thing is if you're going to purchase from a dealer, again, whether it's a 1 or 2 year old lease return, low mileage, or a new work truck, go online and do some research and check out the fleet or online prices because those are usually set and those are competitive. Pick out a certain vehicle model you want and search for that vehicle and look for one that's, low mileage, a couple of years old, and you can typically find some pretty good deals that way. Make sure it's something you can afford and it doesn't cause a financial stress to you. If you can afford it, great, no problem. But if you don't have the finances for it, you might have to downsize some for a while until you can then afford it. But another key thing is, let's say you do have the ability that you could pay cash for a vehicle. That certainly is better than financing because obviously you don't have to pay the interest on the loans. But there is also something called lost opportunity cost. In other words, you take money and purchase a vehicle cash. What you do is, yes, you get the vehicle and you eliminate the finance costs, but at the same time, you also lose the ability for that money that you gave for the vehicle to earn interest for you or any gains in the future. That's called lost opportunity cost. Let's say your car loan was 7% today, and you could have earned something more than that. You actually lost out on the ability of that money to earn. Now, the best of all scenarios, in my opinion, is the personal bank because you can put money into a personal bank, earn dividends. We have companies that are paying 6.5% dividends with guarantees, tax-free, or you can go into an index IUL product where we have historical average returns over the last 20 years of 7 to 10% tax-free with a 5% guaranteed borrowing rate. So my point is, with a personal bank policy, take an IUL. Let's say you made a 10% return on your index and you borrow against it, and the borrowing rate, again, guaranteed for the life of the contract. This is super cool and super powerful. Well, if you made 10% on the money and you borrowed against it to, say, buy a vehicle and it cost you 5% to borrow, what's your money doing? If you're earning 10 and it cost you 5, you're still keeping 5, aren't you? On money you're using to then, say, buy that vehicle. That's the best of all worlds because not only have you eliminated the interest costs of financing a vehicle, but you're still earning interest on that money you used to buy that vehicle. And this is what the wealthy do, using positive arbitrage, leveraging money in a positive way with guarantees, reducing your taxes, and having your money still grow for you even after you spend it and use it for something else. This principle I'm sharing with buying the vehicle could apply to most anything, paying down debt, purchasing other assets. This idea basically leads me to one of the meetings I had with a couple this past week where we had this very same discussion. They were asking for some direction, some goals and what they were trying to accomplish, and they'd had some experience with some other financial agents, advisors, and things like that. But as they pointed out, the advice that they had gotten was rather limited. Some of it was not so good. And what they liked about what I did is we took a holistic approach to everything. We didn't just talk about some of their investments. We also discussed their overall goals, what they were trying to accomplish with everything. We discussed their assets, their debts, how they could reduce their debts, how they could pay it down quicker. So we discuss everything from their real estate, their business loans that they had, investments they had, the entire picture. And one of the things that we identified fairly quickly, and these are intelligent people, successful business people, please understand, but this financial literacy stuff is not common. It just, unfortunately, is not. As I pointed out, they had assets here and they had this and that and all kinds of stuff going on, but with no real general overall plan. In other words, it was just kind of scattered. Had some stuff here, some stuff going on there, but no overarching plan. So one of the points that we brought up was we freed up quite a bit of money. They had some loans for some remodeling on their house. They had some business loans. They were paying extra payments on some of those loans. Unfortunately, they were not doing it as efficiently as they could have. See, the interest rate is more important on a loan than anything. And here's the reason why. I often get asked, should I pay this loan off or not? And the number one question I ask is, what is the interest rate on the loan? That's the key factor. You want to pay off loans on the higher interest rate loans first. It's called the snowball effect. You pay down extra payments on the high interest rate loan. Once you pay that off, then you can apply the payment plus any extra payments you're making on it to the next highest interest rate loan. Keep snowballing that effect until all your loans are paid off, or all the ones you want to pay off are paid off. There's a break point. What is that? Well, in your personal bank policy, we have steady Eddie, consistent, pay 6.5% dividends with guarantees, tax-free, highly liquid. That's your break point. Well, if you can make 6% on your money consistently with guarantees, tax-free, should you pay off a loan that's below that rate, lower than 6%? The answer is no. Because why would you pay a 3 or 4 or 5% interest rate loan when you could be earning 6% on that money? You follow me? Now, the opposite is true if that interest rate on that loan is higher. In their case, they had a couple of loans. One was 7%, one was almost 9%. Should you pay off that 9% loan early? Absolutely, because it's costing you 9%. And if you allocated those dollars to invest, you could only make 6.5 guaranteed. You're losing money, right? So you pay the higher interest rate loan off first. So that's the good, better. Here's the best way. Why not put it into a policy to earn dividends or interest, earn 6.5%, or in an IUL, 7 to 10% historical average, borrow against it in the 5.5% range, and pay off that high interest rate loan. If you're picking up 1 to 5% positive arbitrage on that money, as I was sharing earlier, if you're getting a 10% return on your money, it costs you 5 to borrow. What's your money doing? You're keeping the difference. But if you took that and used it to pay off that 9% loan, for example, not only you're getting rid of the 9% loan, you're also still picking up the 2% or 5% positive arbitrage. So now your return, your positive cash flow to you, if you pay off that loan, is the 9 plus the positive arbitrage, which could be 11, 12, 13% in your favor. I know I threw a lot of numbers out real quickly there. Some of you followed me on that. Some of you didn't. I understand that. But if you want to learn how to pay off debt quicker, how to be more efficient about paying off your debt, perhaps have some funds to work with, I can show you how to accomplish that. By using the personal bank policies, we can accelerate that even faster, get positive arbitrage, and knock down your debt even quicker. I ran out of time before I could get to interest rates, both short and long-term interest rates in the future, so I'll cover that in the next segment. Stay tuned. This is Ferentz, host of the Your Personal Bank Show. Your Personal Bank is a financial concept that allows you to grow your money insured with guarantees, income tax-free, and highly liquid. Also, you have the potential to continue to earn interest on money you invest in other assets, purchase items, or pay expenses. How can you do this? First, invest in a high cash value policy to earn dividends. If you leave money in the policy, it'll grow like any investment, insured with guarantees and tax-free. Second, we establish a bank line of credit using the cash in the policy as collateral. When you access funds, you receive them from the bank. Typically, dividends earned are higher than the interest charged by the bank. You keep the difference. This is known as positive arbitrage. If you want to earn interest on money you spent or invest elsewhere, contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com. Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me at yourpersonalbank.com. So let's talk interest rates. One of the biggest concerns people have now is what's going to happen with the interest rate environment going forward. We now have a pretty good idea who the chairman of the Federal Reserve is going to be. It looks like there's going to be some significant changes in terms of Fed policy and how they operate. If you missed what likely is going to happen, go to yourpersonalbank.com or the Your Personal Bank app. You can go listen to this or any of the previously recorded shows. I shared in the first segment what's likely going to happen. The Federal Reserve has a lot of influence on shorter-term interest rates, shorter-term loans, that is. Think 3 years and less. Lines of credit, home equity lines of credit. That'll benefit your personal bank policies because our borrowing rates will be less, which means we'll get more positive arbitrage. So we're pretty excited about maybe seeing interest rates drop about a point this next year. Longer-term interest rates, especially if you're thinking 10, 20, 30-year loans, is much more impacted by the bond market. The Federal Reserve doesn't have a whole lot of control over that. The bond market is really more affected by debt, particularly how much debt is being sold. The biggest debtor in the world, in the history of the world, is the federal government. They're selling more bonds than at any time in history. If the federal government is spending more money than it's receiving, it can't just print money out of thin air. It has to sell a bond to offset that currency it's printing. We all know there's a record amount of federal debt out there, but on top of that, much of this debt has to be refinanced in the next 12 months. Why is this such a big deal? See, the government sells bonds, all types of different time frames, anywhere from 4 weeks to 30 years and everything in between. In other words, the government pays interest to the bondholder, whoever purchases the bond. They guarantee the interest rate for that time frame, much like a CD. When that bond matures, then they resell the bond at whatever the current interest rate is. Almost $10 trillion of debt, which is about a third of the total outstanding debt, will have to be refinanced or sold in the next 12 months. Well, this is a really, really big deal because when you have that much debt that you have to resell, about $10 trillion, even a 1% difference in interest rates can make a massive difference in how much interest you have to pay on that debt. So that's part of the reason why you're hearing President Trump discuss wanting interest rates lower. The Federal Reserve can definitely directly affect short-term interest rates. If they do lower interest rates, let's say a point or so, that will save the federal government a ton of interest. But the other problem that's going on is interest rates on the longer end of the curve, the bond market, are still on the high side. You take a 30-year fixed mortgage, for example, the rate is based on the 10-year Treasury plus 2 to 3 points. But the Federal Reserve can't just reduce interest rates and you see mortgage rates go down. It doesn't work that way. The bond yields, the 10-year Treasury needs to go down. Well, what's going to cause that to go down? The problem we have is with all this debt that they're selling, that's going to actually push the yield, the longer-term bond yields up, supply and demand again. You have a record amount of supply. How do you get all these bond buyers to buy more of it? Raise the interest or the yield that you're going to pay to entice these bond buyers. But the administration, the Treasury Department, has come up with an idea that could be a very good solution. And frankly, this is brilliant. If you've been listening to the show, you know I was chairman of the board of a bank for a couple of years. So I'm very familiar with how banks operate. And banks have to invest in assets. And one of those assets that banks like to invest in are bonds. Why? They create a cash flow. So you need to understand banks are the opposite of every other financial institution out there. What do I mean by that? Well, most of us understand if you do a profit and loss statement or a balance sheet or something like that, obviously cash is considered an asset for any individual or business. But for a bank and their financials, it's the opposite. Cash is a liability. Why? banks have to generate cash flow. That's why they will take deposits, loan the money out, for example, to create interest. They're on the opposite side of the transaction of everyone else. So if a bank is sitting on a lot of cash, that's actually negative. They want to put that money to work. They want to loan it out or invest it and make some type of return. The banking industry operates on about a 3% margin, or in other words, if they make about a 3% return on the money, they're profitable. They're good. Well, if they bought a treasury, a longer-term treasury, 10, 20, 30 years, today they're probably going to get 4+%. Well, think about all the money that is deposited in banks around the world, literally, in checking, savings, money market accounts. We're talking about literally trillions and trillions of dollars that the bank is paying the depositors little or no interest for the most part. Obviously, they loan it out for a car loan or home loan or some business loan or whatever, they can earn interest. But if they're unable to loan it out, what if they could buy a bond and get, say, 4% interest? And if they're paying you under 1%, well, they're keeping the difference. That's a positive cash flow. Banks don't care really what the interest rates are. They just care about the spread. Well, the problem is the banking industry is limited in their portfolios how much of their portfolio they can buy in bonds. Well, what the current administration and the Treasury Department is proposing is to eliminate that restriction. In other words, allow the banking industry to buy more bonds. Now, if they lift that restriction on banks, you are going to see banks around the world be interested in buying trillions and trillions of dollars of treasury bonds. What will that do? That will create a lot more buyers, will naturally push the prices down. So even though you have a whole lot more bonds to sell, but you also now have a whole lot more buyers available and interested buyers, you could likely get bond yields, those longer-term bond yields, say down a point. Instead of the 10-year treasury being at around, 4.3 or so right now as of this recording, you could get it down a point. Why is that such a big deal? Well, the 10-year treasury is around a little over 4% right now. Where's the typical 30-year fixed mortgage? 6.5. Again, 10-year treasury plus 2 to 3 points gives you the 30-year mortgage rate. If you drop everything a point, if you drop the bond yields a point because you got so many new buyers that are willing to buy all these bonds, look, somebody's going to have to buy all this stuff, right? They found a whole new market to sell to, and the rates go down a bit, the longer-term rates, mortgage rates will also drop about a point or so. If mortgage rates get down to, say, the high 4s or mid 5s, you're probably going to see more activity in the housing market. It's going to free up a lot of this inventory that's been kind of locked up because there's a lot of people out there with really low interest rate mortgages that locked in from the previous decade. It's called the lock-in effect, and they're reluctant to sell because if they have a mortgage and they sell their existing home, they got to get a new mortgage, their interest could literally double. Well, if it gets closer, they're going to be more willing to then sell, which frees up inventory, and then they can move. Because there's a lot of people that are in their homes now that would actually like to move, but just can't afford to. Now, some people have said, hey, interest rates go down, mortgage rates go down, then we're going to see more real estate prices go up. I don't really think that's going to be the case for the most part. Why? There's a lot more inventory. Inventory typically impacts housing prices far more than interest rates. That's just a statistical fact. Look at history. So that's another misnomer. Also, you've got a situation where, for the first time in history, the new home premium has disappeared. In other words, it's always been, until very recently, a new home costs more than an existing home. That has actually changed. Why? Well, in many parts of the country, Florida, Texas, the Southeast in particular, and some other places, the Southwest, the builders have built a lot of homes. The inventory has gotten back to pre-COVID levels, even in many places. So there's a lot of inventory. So the prices are coming down, the new home prices in particular. There's been more of a delay with the existing home prices because the existing homeowners, they're not as sophisticated. They're not necessarily paying as close attention to what the economy's doing or what house prices are doing. They're living their life. And they heard their neighbor a year or two sold their house for this price. So they're thinking if they wanted to sell, they might be able to get a similar price, not realizing the whole market has changed. It takes a couple years for people to kind of realize what's going on. Existing homeowners overall move or react far slower than, say, home builders. Home builders are in the business. They know what's going on. They're offering record incentives because, well, they've built these homes and they got to sell them. So I don't necessarily think that even if interest rates come down, say a point, mortgage interest rates come down a point or two, like I said, from explaining earlier, banks being able to buy more bonds, creating a whole new market for those, which would lower mortgage rates, which would be good for freeing up some inventory and enable more people to be able to afford homes, helps the housing affordability crisis. I don't necessarily think we're going to see some jumps in prices because, one, they went up so far, so fast in a few years. I mean, just like the experience we've seen just recently with gold and silver, look what happened there. Prices go up too far, too fast. There's a correction. A correction is going to occur. I don't care what the asset is. That's the cycle. And it's repeated itself over and over and over again for centuries. In 1500s Holland, some tulip bulbs cost more than a house at that time. This is not a new phenomenon. This happens over and over and over again. It's human nature. See, it doesn't matter if it's the 1500s or the 2026. Human beings are human beings. Emotions are fear and greed are real, and those things don't ever change. And that's why I was sharing a couple of weeks ago where I felt like some of the fears that were pushing the gold and silver run-up were overblown. Also, I forgot to mention, but some of the causes of that, of course, was leveraging. We were seeing record levels of leverage in the gold and silver markets. We're seeing similar that with the stock markets, particularly in the tech arena. And when you see a correction, they become more exaggerated because of the leverage. So leveraging just makes the ups go faster and stronger, and the downs also equally do that. So you got the escalator up, you got the elevator down, but all that gets exaggerated with leverage. A lot of investors are leveraged. The prices start to go down. They start getting margin calls. You don't have a choice then. You got 24 hours to come up with the money. People have to get out regardless of the price, which just accelerates or cascades everything. When you see things go up really strong in a short period of time, the risk is elevated. If there's a significant amount of leverage, and typically there is, particularly in today's age investment world that we're in, when you see that type of stuff, you're going to see leverage almost without exception. We have a clearer picture today of what the economic situation is going to be, I think, in the next year or two going forward. One, there's going to be significant change. Change is going to create volatility. It's going to create uncertainty. We're going to see some bumps in the road. It's going to be a rough ride, but overall, in the long run, I'm encouraged by, again, I think we're going to see a little bit lower interest rates later in this year, maybe a little bit more lower mortgage rates too. The economy is going to be picking up, I believe, in a lot of ways. And I guess I'm going to encourage you to stay tuned in the last segment because that's some thoughts I want to share with you, what I believe the economy is going to do through the rest of 2026 and beyond. So stay tuned.
This is Ference, host of Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to, 1, grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2, double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3, a 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. Today we've been discussing a lot of what happened. Why did gold and silver prices suddenly, after being going up amazingly, tremendously amount over this past year and even more recent, why do we see such a correction? And likely you will continue to see some of that going forward. Again, it has to do with change. The economic landscape that we're in going forward will be very different 2026 forward versus what it's been for the past decade. Federal Reserve policy clearly is going to change significantly. Federal Reserve will likely become less involved in economic activity, less likely to print money, reduce its balance sheet, less likely to reduce interest rates dramatically. Going to let the markets run and do their thing, so to speak. That will create more volatility, particularly in the changeover of what's going on. Going to be some uncertainty, some volatility. It's going to feel uncomfortable for a lot of people because, so many have gotten used to what things have been like, frankly, since 2008 for the most part, where the Federal Reserve is just almost continuously just kept pumping money into the system, pumping money, which means things just keep going up, and up. Yes, you have some blips in there, but generally speaking, just the asset prices keep going up. That is likely going to change and change significantly. Or if they remove the limitation of how much bonds banks can purchase, that will likely create a whole new group of bond buyers that have only been there partially, and that'll help with longer-term bond yields, which will help for longer-term mortgage interest rates stabilize and reduce somewhat. I don't anticipate any significant massive changes. I don't anticipate seeing 3% 30-year fixed mortgages again. Please understand that. But could we see 5% mortgages, maybe even high 4s? I think that's likely. Do I think shorter-term interest rates from the Fed before the end of the year being a little bit lower than they are now, half to maybe a point lower? I think that's very likely. That means lines of credit, home equity lines of credit, short-term borrowing will benefit your personal bank, lines of credit, things like that. We'll have a lower borrowing cost, create a larger positive arbitrage. That'll be great. The markets, stocks, real estate, I think we're going to see some more volatility, some reductions, because again, if the Fed is not printing money consistently all the time and continuing to push this asset bubble, it's like pumping up a balloon. Federal Reserve, for the most part, since 2008, has just been pumping and pumping and pumping this balloon with rare exceptions. And I don't know if the balloon's going to pop or blow per se. It's just they're going to stop pumping it. Start releasing by selling off some of their assets. It'll start releasing some of the air from it, hopefully in a controlled manner. They're walking a fine line here, to be fair. There's going to be some bumps along the road. There's going to be it's not going to be a smooth ride, but hopefully it won't be a crisis. But the days of assets just continue to go up all the time are probably over. If an asset goes up in value in the future, it'll because there's a compelling reason for it to do so. A company's done real well, has a new product, a new technology, gained new earnings, things like that. We'll get back to what was now old school, where you kind of had to find assets you had to have a reason or a compelling reason to invest instead of just investing and assuming everything's just going to go up. That's going to be a big change. That's going to be a big adjustment for a lot of people. But I'm also, another piece of it that's encouraging is GDP growth has been picking up quite significantly. We're seeing 3, even close to 4% GDP growth. And for a country as large as we are and as mature of an economy as we have, those are really good numbers. There's trillions of dollars being invested into this country. The big, beautiful bill has now gone into effect. So a lot of the depreciation, business write-offs and things like that are now continued or made permanent so businesses can plan accordingly. And that's the other piece of why I believe this debt crisis that we've been marching towards, this fiscal cliff, at the very least, I believe is being delayed. I don't know if it's being completely eliminated, but it certainly has been delayed, because if you can grow GDP and you can reduce the growth of your interest, at least somewhat, by keeping your bond yields somewhat controlled, that certainly delays the crisis. It's kind of like debt to income ratio. Most people understand if you go for a mortgage, you're going to qualify for a loan, they look at how much your income is to debt, right? And that's what the problem has been. We have GDP and our debt, and the debt is about 120% of GDP. What that means is If you earned $100,000 a year, you'd have $120,000 of debt. Can you manage that? Yes. Is it ideal? No, because you're having to pay interest on that debt and you're not paying it down and it's continuing to grow. But if it starts growing at a slower rate and you're increasing your income, there's GDP growing, you can get that under control. You can get that managed. When I'm meeting with an individual or a business client and they've got a debt challenge, I mean, there's really two solutions to solving any debt challenge: make more money or spend less. Well, we can't get Congress to spend less. Can't seem to get the government to spend much less. So the best solution is try to make more. You can eventually, over time, reduce your debt situation and get it manageable. That's what's the encouraging part. Now, again, it's a threading the needle kind of thing. And that's why it's not going to be necessarily a smooth ride all the way through. But it truly is the golden age of fixed assets and the best time for an index product. I think in the next 2-3 years plus, we can see some really strong economic growth. We can see some market growth that's pretty substantial. But also in the shorter term, particularly the next year or so, we can sure see some volatility. If you're not interested in riding the ride, which could get pretty stomach churning in a volatile situation where we're going to see significant changes this year, folks, with the Federal Reserve policy changes and et cetera. Some of it can be pretty stomach churning, frankly, and that can get really stressful. And you want to be in a situation where, hey, if the markets continue to go up or the indexes go up, man, we've got some tremendous, we can get in S&P and NASDAQ indexes and things like that. Do you realize if you invest in a NASDAQ 100 and an S&P 500, you're diversified in 600 different companies? You've got all the tech stocks, and you got just about every Standard & Poor's considers the best and the brightest companies, but you don't have the downside risk. The principal is guaranteed. And this can all be done with no fees, no caps, so unlimited upside. Some of the negative connotation with index products has been, poor index performance. Well, 80% of indexes out there, and there's about 500-600 of them, but about 80% of them have low single-digit average annual returns for the past decade. So if you have an index product or you looked at one, there's an 80% chance you're going to have a poor performance. But some of the proprietary software that I have access to, and if you meet with me, I'll show you how the sausage is made. I'll show you all the indexes and the actual returns, 1, 5, 10-year returns. I'm told by this software company that like less than 1% of agents and advisors have access to this software, these performance reports. It's not public record for the most part. It's difficult to find, if you can find it at all. And I've had prospective clients and clients who had products or with other companies reach out to other agents, advisors, and other companies even and ask, hey, what's the performance report on these indexes? And they get a blank stare. Look, if you don't know what these indexes have done or what they likely can do, no offense, but you're flying blind. So is the agent, so is the advisor, for the most part. They can make some educated guesses. And just because an index has averaged 8 to 11% over the past decade or two doesn't necessarily mean it's going to in the future. I get that. But at the same time, if you're looking at another index that's averaged 3 or 4, let's say, and has never done more than 6 or 7 ever, what's the odds of it all of a sudden doing 10 next in the future? Highly unlikely. Where one that's consistently done that is much more likely to do that in the future, unless there's some compelling reason, a management change or a significant technology change or economic change. I understand that, but those are things we keep track of also and pay attention to. My point is you'll get to see real quick, and you'll see about 20% of the indexes out there have performed consistently and likely will in the future. And look, if you do get involved and invest, and then there happens to be a correction, well, you don't lose the money you put in. That's a nice thing. But you also get to reset at the lower index number. That's what's so powerful. And this is the part most people miss. Most people understand if you're invested in the market and it goes down, you lost money that year. But the part they forget is how long does it take to recover from that loss? Historical market corrections, the average to recover, to get back to even, the shortest has been 18 months to 29 years. The average is about 5 to 15 years. The .com, if you were in NASDAQ in 2000, it took 15 years for you to get back to even. If you were in the S&P 500 in 2008, It took you 5.5 years to get back to even. Did you make any money during those 5 to 15-year recovery periods? No, you just got back to where you were. So that's lost time. Why not be in an index? Again, unlimited upside potential, no downside risk, no fees, no caps. If the market goes up, you're going to go up. If it goes down, you don't lose. And then when it does recover from a correction, you start at the higher amount because you didn't lose, right? Do you realize when we look at these different indexes over, say, a decade period of time, if somebody invested directly in the market versus one of these indexes, oftentimes, frankly, most of the time, the person in the index has more money. It's because they didn't participate in the losses. And then they didn't have to lose the lost time of making up the lost ground just to get back to even. That's the difference. So if you're interested in learning how to maximize your returns, no downside risk, you want to eliminate your fees, you want to make sure you probably are going to have more money, you just don't want to stomach the ride of the volatility that's likely coming because of all these changes, yet take advantage of the upside without having to suffer the downsides, contact me at yourpersonalbank.com. You'll find it extremely educational. I get asked this question all the time. How can you do that? Once I show you, you give me 10 or 15 minutes, I'll show you how these companies do this. It's not new. It's how institutional investors, banks, insurance companies invest, pension funds, you name it. It's not a new idea. This has been around for decades and decades. But once you understand how it's done, you're like the light bulb comes on and you realize this makes sense. And what I find is once people learn how this really works and they start investing their money here and they start comparing to what they were doing before, you know what? They don't go back. So if you haven't looked into this, or if somebody you've talked to, they weren't able to show you dozens of companies and hundreds of products available, literally, so you ensure you have the best one available. They weren't able to show you the performance reports of the indexes, hundreds of indexes, literally. You probably weren't shown the best product available. And if you do have an index and you're not overly happy with the returns, and you like to double, triple, sometimes even quadruple your returns, yet you feel stuck because there's a early surrender penalty to get out, we've got products that'll pay up to a 29% bonus to cover your penalty and then give you often 2, sometimes 3 times the upside potential growth. So you can increase your returns going forward. So you're ahead day one with faster, better growth going forward. If that's you, contact me at yourpersonalbank.com. Stay tuned next week to the Your Personal Bank Show for more great information. And as long as it's on our money, in God we trust.
Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required.
Concerned about market risk? I'm Ference Toth, host of the Your Personal Bank Show. The S&P 500 valuations are higher than at any time ever recorded in stock market history. This includes 1929 and 1999. We all know what happened afterwards. It wasn't pretty. Elevated valuations increase risk to the downside. Annuities and Your Personal Bank offer unlimited upside with no downside market risk. Your principal is guaranteed. Contact Ference at yourpersonalbank.com to maximize returns, reduce market risk, increase liquidity, and reduce taxes.